Good afternoon. Welcome to the i3 ESG webinar co-hosted with PGIM on this very timely topic of pricing climate risk. I'm Tech 10 with i3, and I'm pleased to have Sharia Anthea, Head of Thematic Investing at PGIM, and Lucas Kengmana, Senior Investment Strategist at the New Zealand Superannuation Fund, join us today. Lucas will be with us in a moment. For now, I'd just like to introduce Sharia, and Sharia's background is in monetary policy, where he was part of the markets group at the Federal Reserve Bank of New York and led several initiatives around QE programs during the global financial crisis. Before joining PGIM in 2019, Sharia was the chief US economist for Nippon Life Global Investors. More interestingly, Sharia co-authored a recent PGIM research report entitled Weathering Climate Change, pun intended, I suppose. And he'll be sharing excerpts of that research in today's discussion. So we'll kick off today's session covering that research. I'll introduce Lucas when he joins us in a moment. And let me just set the context for today's topic. So climate risk, and I think much has been said and discussed. I guess it's safe to say that it will increasingly be reflected in market prices, leading to a repricing across asset classes, sectors, companies, and individual securities. Indeed, it is no longer a question of if, but whether the transition will be an orderly one, say ushered in by government measures and gradual market adjustments, or triggered by a series of so-called Minsky moments. I think some of us are familiar with the former Bank of England Governor Mark Carney, who's coined this with a Minsky moment, meaning an abrupt or sharp decline in markets. Now, regardless of the scenarios, and I'm aware different funds have modeled in different scenarios based on these, implications for investor portfolios will be significant. So we don't have all the answers here, but I propose we'll cover today's topic in this framework. Firstly, climate risk, defining and identifying, putting a frame around what it is. Secondly, data. Now, I'm sure we've all had discussions around the incompleteness and inconsistency of certain data providers. However, I think for today's purposes, let's cover the progress made. In fact, Sharia in his research mentioned about the data revolution. We'll cover a bit more on that. So what do we do in spite of the difficulties? And last but certainly, I think most important, around portfolio implementation, implications, valuations, decisions, and these are really tough ones. Are we at a point where we can make certain decisions based on what's available, adjustments, buy, sell, hold decisions regarding securities or asset classes? I think the jury's still out there, and that's really a tough decision, but hopefully we can sort of cover that in some form. So in terms of format, this will be a fireside chat between myself, Sharia, and Lucas for a total of 40 minutes. I'll encourage you, the audience, to ask questions via the question box, and we'll endeavor to answer them in the course of the conversation. So just type those questions in the box. A disclaimer, this webinar is for educational purposes only. It does not constitute financial advice and is intended for wholesale and institutional investors only. So Sharia, welcome again. Let me fast forward to, I think, chapter 3 of your research report, where you covered market pricing. And you talk about aspects of climate change and say there were certain aspects that were already reflected in market prices. Obviously, others were not. The question to kick off, what are they? And as a follow-up, why and why not?
So, take when it comes to how well are markets pricing and climate risk, you really nailed it. The short answer is inconsistently and incompletely. And this imperfect pricing presents both risks and opportunities for investors. Our research showed that where there's granular information, where there's some granular data, where there's a reasonable certainty around a specific impact, it usually gets priced in. Now, this isn't rocket science, right? The better you can measure a risk, the better you can price it. So it's no surprise, for example, that government policies that drive greater transparency, visibility around climate impact, and the cost of that impact has played a big part so far in markets pricing and climate risk. Let me add here that government policy is an important catalyst, but not necessarily the only one at all. So what do I mean by government policy in this context? Well, an example of this would be around transition risk around electric utilities in Europe. You know, utilities that are heavily reliant on coal-fired plants, for example, face much more transition risk. So with an EU-wide emissions trading system that's in place, there's a market-based proxy for the cost of carbon emission, and investors can apply that implied cost to future cash flows of power companies, and ta-da, they have a way to tangibly price in transition risk. And not only is this aspect of climate risk largely priced into the market in Europe, but it's done so with some degree of granularity as well. That is, you know, markets can importantly differentiate somewhat between leaders and laggards in this space.
And there are those that are not priced in. I mean, you mentioned the role of government. I guess that's really important. And other sectors that are not priced in or will be priced in at some stage.
Yeah. So, you know, our research showed that sovereign bonds are a market that tends to really overlook some obvious climate risk. We know, for example, that the physical risk from climate change will have a varied impact across countries, but yet there is little indication that sovereign bond markets account for these differences. You know, Russia and India provide a really good example here. Both have a similar credit rating, roughly a similar yield. However, it's widely known that India will be significantly more impacted by the physical risks. So I'm talking about water stress, extreme heat, and sea level rises, for example, than Russia. In fact, estimates have climate change shaving off 3% from Indian GDP growth annually for the next 20 years or so. And I'm just talking about the physical risk now. Now, of course, climate risk is not the sole factor for sovereign bond pricing or sovereign bond investing, but this is a useful example of how markets may not be accounting for this big differential, especially when it comes to longer duration bonds of, you know, 10, 20, and even 30 years or more.
It reminds me when you talk about duration again, back to Mark Carney. I don't mean to keep quoting him, but he talked about the tragedy of the horizons, where often in issue of climate, it's a longer term problem, if you like, that's not captured in short term metrics. I guess, Sherry, as a follow-up to that, you know, some are priced, some are not priced, or would be at some stage. And I know we'll cover the data piece, and that's where it might change things. So talk about catalysts. I mean, what might cause you know, markets to reprice? Sure.
So, you know, while markets are not currently doing a great job of pricing in climate risk now, one sort of interesting conclusion from our work was that it's, as you noted, Tech, it's no longer a question of if markets will more fully price it in, but when. And for investors, the key question we believe is, what are the catalysts for this repricing? So our paper highlights, you know, several catalysts to, you know, for asset prices to reflect climate risk more fully. You know, maybe I can touch on one or two here.
Sure.
So first, as we mentioned earlier, was government policy to encourage reporting, better disclosures by companies. You know, any efforts to improve the uniformity of sort of reporting and disclosures. All of this is very, very beneficial. Also, policies that put a price on carbon emissions help as well. But as I noted earlier, government policy is far from the only catalyst, and our research shows that it is not likely to be the main catalyst going forward. What we have our eye on, Tech, is the data revolution that's already underway for the last five or 6 years. So what exactly do I mean by this? Climate analytics and data today are of better quality, they're more granular and more accessible to investors than ever before. Now, before my excessive cheerleading for climate data raises the collective blood pressure of participants on this webinar, let me be very, very clear. climate data and analytics are far from perfect. There's much room for improvement, especially around uniformity of reporting, uniformity of disclosures. There are significant gaps in private assets. But what I am referring to here is the overall trend. And that is, there's no question that climate data has been getting better, quality is improving, the data is more granular and more accessible. And hence, more and more climate risk will be priced into asset markets the better the data gets. And for investors where markets are actually a bit reluctant or slow to price in climate, better and more granular data can help them manage risks and, importantly, even open up some investment opportunities as well.
Right, and then Sherry, I'd like to take up the questions around data, or we call it data over here, in a moment, because I think specific examples will help. But maybe one final question for you before I ask Lucas to join us. Again, it's that caught around Minsky moment where, again, whether it's Mark Carney and others have warned that there would be this Climate Minsky moment. But as I understand, you beg to differ. You don't see that happening. Why?
So you're absolutely right. Governor Carney has warned of a Climate Minsky moment, and while that can't be ruled out completely, we do respectfully disagree. A one-time abrupt repricing of all markets all at once is not our base case. There are, and the reason for that, Tech, is that there are simply too many catalysts that are already nudging individual markets in different regions to price in climate change more and more. We've already mentioned two. There are others. For example, the collective nudges on companies from their stakeholders and from their customers for climate disclosures and for carbon neutral pledges would be another very powerful catalyst for market pricing. So the repricing of asset markets may not proceed smoothly or uniformly across all markets. It'll likely occur in fits and spurts, step by step, but importantly, over time, we believe, rather than all at once.
Thank you. I think it's a good time. Thanks for setting that framework. I will now invite Lucas to join us on this session. Welcome, Lucas. Now, as Lucas adjusts his, maybe you could see more of you in the screen. I'll just, again, for the benefit of our audience, introduce Lucas. So Lucas Kangmana works in New Zealand Superannuation Fund's responsible investment team on climate change and the broader ESG issues. He authored, and I think this is a really good point to draw in from Sherry's discussion, he authored the fund's first TCFD report, and we'll get into more data later, and leads the fund's carbon footprint work. He's also a founding member of, and let me see if I get this right, Greenpreneurs. It's an online accelerator for young entrepreneurs working on green startups in developing countries. So welcome again, Lucas. Lucas, perhaps to kick off, to set the scene, if you could articulate for us, New Zealand Super's approach to climate change.
Yeah, sure. So, look, as very long-term investors, we've been interested in climate change for a very long time. It's hard to put a finger on exactly when, but at least since 2007. In 2016, we began to become convinced that the market was not properly pricing in climate risks. In particular, we're seeing more and more reports suggesting that this was the case. And when we talked to analysts about how they were adjusting their estimates for climate change, we were tending to hear that, look, this was outside of the timeframes of their estimates, and they weren't really building it in. So, as any good investor, where we see a risk that we're not getting rewarded for, we decided, look, we needed to reduce our exposure to climate change. So we put in place a 4-part climate change investment strategy. So part 1 of that investment strategy was to reduce. So that meant that we footprinted our portfolio, set targets against that footprint to reduce our emissions. In our case, we decided to use a target relative to the benchmark, and then also targets to reduce our exposure to fossil fuel reserves. So that was the first part of our strategy. The second part was analyze, which is a bottom-up approach. So reduce is a top-down. We take a high-level targets, and then we tilt the overall portfolio. Reduce, starts from the bottom up, and we look at individual investments and implement or integrate climate change considerations into that. Then the third bit was called engage. So, that's just active engagement with companies, including voting and talking to management. And finally, search, where we said, okay, we want to explicitly look at sort of top best-in-class companies who are really going to benefit from climate change.
And Lucas, Sharia earlier touched about the use of data, and again, the view is that will then obviously gradually be nudging pricing or the repricing of assets. How do you see data, and I guess especially in the context of your work with TCFD, and that again would influence the work in the portfolio?
Yeah, look, so data is crucial, and I think Shreya mentioned this as well. Like, we agree it's far from perfect, but we do think it's trending in the right direction. So we've kind of taken a leap of faith, and we are relying on the data, even though we know that it's not, it's not perfect.
And can I get a bit more granular? And maybe I could come back to Sharia. So we talk about the data revolution and how, again, that's nudging changes in market pricing. Can you give us perhaps more granular examples of how that's happening in that world?
Sure. So we've all been talking about how we know markets don't do a great job of pricing and climate risk, right? And our research found that investors who really embrace new climate analytics can at times differentiate risk where the market may not be doing so currently. They can not only better manage climate risk in this way, but they can sort of find some opportunities. Let me give you an example of what I'm talking about. So I spoke a little bit earlier about this sort of simple example of Russia and India, and maybe tilting a sovereign bond portfolio away from areas of high risk like India and towards areas of lower risk may be a way of acting on the climate data. And once again, especially for longer duration debt. One quite unexpected finding from our research was that more investors are finding investment opportunity in climate change. What do I mean by this? Well, a good example comes up here in real estate markets. I'm talking about coastal properties in places like Melbourne, Mumbai, and Miami are often uniformly categorized as high risk due to potential for flooding from more frequent heavy storms, rising sea levels, and typical flood maps cover these areas at a postal code level or at a district level. However, data-savvy investors can leverage much more granular flood maps that make better use of precise geolocation and other alternative data, and they can actually distinguish flood risk at a block-by-block level or even property-by-property level. So investors who leverage these new, more granular flood maps, for example, can find what we call hidden gems. That is, properties that are more resilient to flooding, either because of slight elevation changes or how they're constructed, but yet are priced with the same steep discount as their neighbors. This is one example of how investors can leverage better climate analytics and maybe even find some investment opportunities in imperfectly priced markets.
Lucas, again, as an investor, I'm curious to know how you implemented some of these. I mean, you would have that wide range of data that's available from multiple sources. Sharia gave a number of really good examples at a very granular level. How did they bring it together on your end?
Yeah, so I mean, I guess we do two different things. So one is to change our passive portfolio. And at this level, we're really using some of that, maybe less robust or less exact, but more widely available data points. I mean, effectively just scope 1 and 2 emissions, revenue of companies, and the fossil fuel reserves holdings of these companies. And we just set targets for our portfolio, and then we adjust our portfolio so that it achieves those targets. So, you know, there's nothing super intelligent about that, but you know, when we were trying to get our overall risk down quickly, that was a good way to start the process. The second thing that we've done is we look asset by asset, and what we're doing there, we've developed an asset valuation framework. It's basically a way to do the DCF that makes sure that we are confident that we're covering off on all the right climate change questions. So, you know, as with any DCF or discounted cash flow analysis, the first step is to understand the value drivers for the business. So we do that. Then we assess the sources of climate change risk and opportunities for that particular business. So it's kind of a brainstorming session. We do have a framework that says, look, most of the opportunities will sit in one of 6 things. Technology. Sorry, I should be able to roll these off the top of my head, but I'm going to just have to refer very quickly to my notes. Yes, so technology, resource availability, the impact of physical damages, policy, supply and demand, and liability. So we say, okay, look, most of the impacts from climate change are going to be one of these 6 things. So consider all of them and make a list of the things that you think are relevant for this business. Third is we filter these things that we've identified. We ask 2 questions. One, is this material? If it's not really material, we'll mention it in the completion note, but we won't put it into our model. If it is material, then we say, can we quantify this? And to the extent we can quantify it, we'll integrate it directly into the valuation in our next step, into the cash flow of the business, I should say, in our next step. And if we can't quantify it, then we will look at other ways to reflect this. So either adjusting reflecting it in the multiple we put on the business in our terminal value, or reflecting it in the discount rate that we apply.
Sure.
And then,
I want to
sorry, that's
a bit on this.
Just one more step here, sorry, that I should just cover off on, which is once we've done the transaction, we continue to own the business actively, and we have that list of risks that we've identified, and we continue to make sure that we take those into account in managing the company.
I wanted to labor on this point a bit because the implementation of the portfolio is most contentious, and I know there's lots of questions. And if I can break it down in perhaps questions for both of you, at the risk of being too simplistic here, there is that top-down, bottom-up. I think Sherry had given examples, whether it's flooding, and I think in your report you talk about pharmaceuticals, water scarcity. So these are very granular type incidents that impact particular assets or asset classes. Then there's a top-down approach, there's a bottom-up approach, and I think as far as New Zealand Super is concerned, I think the way you structure a portfolio, as I understand, on the public side, the listed security side, it's fairly, I guess safe to say, fairly passive-like, whereas on the unlisted side, you're a lot more active just because of transactions. So again, I'm trying to think, how do you implement that from top-down, bottom-up, and different types of asset classes? It's a bit of a loaded question here. Lucas first, and then maybe Sharia could have a go.
Sure.
Yeah. So I mean, I think you captured it, perfectly. We are more passive in our equity holdings, although we do also have some multi-factor mandates as well. But yes, we take more of a top-down approach to those because we found that that's just an easy way to get our emissions down very quickly, and it would be quite a large shift from in approach to do this. I guess more. To use more, a lot of data sources, that would be quite a philosophical shift for us. Conversely, the direct assets, the assets that we're owning in where we have significant control and own, a lot, we already are putting in quite a lot of detailed analysis before we buy them on all sorts of things. So, doing that detailed analysis, granular analysis on climate change just makes sense to us. But the long term, the objective is to do both.
Yes, I'm trying to zero in on the sort of the practical aspect of implementation. Sharia, thoughts on that?
So, you raise a really interesting sort of question and a different perspective. And like when it comes to sort of risks that sort of cut across asset classes that aren't sort of security specific, there are an awful lot of indirect or what we call hidden risks around climate change, and that was one of the interesting findings of our research, of our paper. And these hidden risks, as I noted, can really span asset classes. And here's an example. Global vulnerabilities in supply chains have been exposed by COVID, and they're apparent even today. And climate change is poised to expose new vulnerabilities across new industries as well. So let me give you an example of what I'm talking about. And you touched on this briefly, Tech. We don't often think of Swiss or Japanese pharmaceutical companies as being highly exposed to climate risk, but they are through their supply chains. Many key production facilities and suppliers are located in regions with high risk to water stress, extreme heat, areas like Israel and India. And over the long term, pharma companies with supply chain exposure to these areas have a significantly higher probability of supply disruptions. And we've all learned over the last year and a half, 2 years, that supply disruptions can impact production, can impact sales, and ultimately cash flows. So here is a hidden risk. What can investors do about this? And real quick, one example of an action to take is overlaying the precise geolocation of key production facilities and suppliers with detailed maps of extreme heat and water stress can identify for analysts or for investors which pharma firms, for example, may be at most risk. And then using that information to maybe tilt a global equities portfolio, for example, or a bond portfolio away from those firms at most risk can be a way for investors to actually act on some of these hidden risks around climate change and leverage some of that alternative data that we're talking about.
And Lucas, again, back to you, and again, I think top down, and I understand, I think particularly more for the public portfolio, where you rely on analytics and examples that, in fact, Shara has mentioned. I guess, does it mean that you take a particular stand on the amount of, call it, carbon intensity they like in the portfolio and benchmark to some of these things? And if so, in fact, there's a question here for you. This sort of top-down, often quantitative type framework approach, does that then imply an exclusion strategy? And as I understand, in engagement, you engage until you can't, then you exclude, I mean, generally speaking. But by applying that sort of quant overlay, if you like, in the first instance, implicitly it's an exclusion strategy. Does that go against what you normally do?
Yeah, so that's a really good point. I guess this comes back to the fact that we don't see, or at least historically, we haven't looked at climate change as an ethical set of exclusions. We see this as an investment set of exclusions. And so we just feel like there's carbon risk there. We're not making judgments about any of these companies by excluding them. We're just saying we don't think we'll get a good return on them, so we're excluding them. So we don't feel any obligation to engage first on that basis. In saying that, we do actually consider whether companies have a plan. So basically, we use MSCI. They have a rating for carbon emissions, an ESG score for carbon emissions, and we say if you're a top quartile company, we will keep you in the portfolio even if your carbon intensity is higher than is sufficiently high that we would normally kick you out, I guess.
I guess that's a judgment call at some stage. It's I think, to Shara's point, that hidden cost, you got to balance. Shara, you wanted to comment?
Fossil fuel industries and oil drilling and extracting are the are one of the quintessential examples of a high carbon emission industry, and they're really creating there's a real interesting area there for investors, and what we're observing is, as Lucas was talking about, is a range of approaches that investors are taking, and how they're actually becoming more active in their ESG approach. So, take early ESG models, as you noted, excluded oil extraction companies altogether. They were banished from portfolios altogether. And the rationale, of course, is that this industry contributes mightily to carbon emissions. But this approach was pretty blunt, and it painted all players with the same broad brush. And this passive all or nothing approach prevailed for some time. Now let's fast forward five or 6 years. Climate data analytics are better now. They're more granular. They're more accessible to investors. Some investors, such as Lucas, actually consider the plans of companies as well. And some investors are just not satisfied with a passive divestment approach, and they see opportunities to possibly take a more active approach to ESG investing. That is, they want to reward the greenest firms in the space, the Shells and the Totals of the world. They want to actively influence the brownest oil companies, the Chevrons and the Exxons. In short, rather than being satisfied with passively divesting, more and more investors want to actively bend that carbon curve. And today, more are able to identify and differentiate firms, the greenest firms within a brown industry, whether it's their carbon emissions currently, whether it's their sort of investment in renewable energy, whether it's their plans and commitment to do so, as Lucas called out. We've definitely seen a trend towards more active security selection in this way, especially from equity investors.
And I think the part of fossil fuels, I remember reading a paragraph, and I'm going to quote from your research report around fossil fuels, and in fact I'm keen to get Lucas's thoughts on that as well. And Sherry, you made clear that, say, look, although there is a clear trend towards more green energy, with US renewable energy generation having doubled since 2000, fossil fuels will not disappear overnight. In fact, while renewable energy consumption is expected to double again between now and the next 20 years, fossil fuels are still projected to make up more than 70% of the global energy consumed in 2050. And then more recently, I think that was a clip on Bloomberg, which talked about the demand surge that has recently challenged a lot of the assumptions about how quickly the world can decarbonize. I think we're familiar with the energy crisis happening in a couple of countries currently. Yeah. And as such, many of these consuming nations have zoned in on the older fuels. I think the quote was, the White House has even urged OPEC cartel to increase oil production fast. The International Energy Agency has asked Russia to pump more gas. China has ordered banks to prioritize loans to coal miners and so on and so forth. So look, that then got me thinking, like, the whole notion around stranded asset risk. Is there such a thing? Lucas, you can comment?
Well, look, I mean, I think there absolutely is stranded asset risk. At the same time, I totally understand where Sharia is coming from, and I don't think energies, fossil fuels are going to disappear tomorrow. I guess there's also, I think sometimes this debate gets, to me, a little bit more complicated than it maybe needs to be as an investor. We seem to be very focused on, well, what do we need to do for the world, and making our portfolio one that is, can be universally applicable. At the end of the day, I think, we're just a bunch of investors who have to make judgments, and we don't need to necessarily make sure that these judgments are universally applicable.
Sure. I think it's a nuanced approach, where your comment earlier around how even in the top quartile MSCI in terms of carbon intensity doesn't mean you exclude. There are processes around it. Lucas, I wanted to sort of go a bit further into your comments around portfolio strategy earlier, where we've covered a bit on the public market side, where by and large there's a dependence on the availability of data, which again, to Sharia's point, has been improving. On the private or the unlisted side, I understand at New Zealand Super, you adopt sort of like a scenario-based type testing to look at whether it's private equity and real assets. Could you elaborate on how that process works?
Yeah, so it's not so much a scenario. Well, what we have is a set of internal scenarios, and each of those have some, I guess, default data settings. So we have a view on, what kind of wind speeds will change, what kind of sea level rises we might see in a 3-degree scenario. And so that means that because we ask our analysts to integrate this work, when they go out and sit down to do their 3-degree scenario, they have a starting point. Now, sometimes if there's something unique about that asset, or the point is particularly important, they will go out and get even more granular, more accurate data. But this is a sort of shortcut for them for the bulk of their analysis to allow them to do it quite quickly.
Mm-hmm. And I guess, Sharia, based on your research, I mean, examples of whether the interaction with other investors, how they approach sort of private unlisted assets, whether it's real estate, infrastructure, what has been your observations?
Sure. So we spoke about hidden gems in commercial real estate. When it comes to other sort of private assets like private equity and venture capital, let's say, there are 2 really interesting innovative technologies out there that are very early stage that have real potential to be game changers when it comes to climate change. And they're at really nascent stages. They're not really accessible, like I said, in public markets. Whether they work out at scale is quite uncertain. And right now, the best way for investors to participate them is through PE and VC. So these two technologies, the first are hydrogen fuel cells, and the second is carbon capture and storage, or CCS. So hydrogen fuel cells, the technology already exists. They're already powering forklifts at Amazon warehouses. They're already powering cars and even some ships. And the promise of hydrogen fuel cells lies in the fact that it has the potential to deliver immense power over relatively prolonged periods and can recharge fairly quickly, especially compared to sort of current battery technology. And this really opens up the possibility of decarbonizing some of the heaviest carbon emitting industries, things like air travel and iron and aluminum smelting, for example. The challenges around it, of course, are not trivial. They're very, very substantial. Producing hydrogen is currently a carbon emitting process, and it's not exactly inexpensive. There's an awful lot of research being done now around producing green hydrogen, but it feels like it's in its early stages. It's not clear it can be done at the scale needed to actually decarbonize major parts of the economy. The second technology is certainly more speculative for sure, but potentially more transformative as well. So carbon capture and storage is essentially plucking carbon out of the air and burying it deep underground or under the sea. And this offers the possibility of not merely reducing the level of carbon emitted into the air, but if done at scale and economically, it could actually reduce the level of carbon in the atmosphere altogether. So potentially a real game changer, but also very, very early stage. There is some technology around plucking carbon and sort of burying it deep underground or under the sea, but it hasn't really come together yet. It's very, very expensive to do, and it's certainly not, and we're not able to do it at scale yet. But these are two really highly speculative areas that investors in private markets can keep their eye on, we think.
Mm-hmm. I have another question from the audience, and I think could be to both of you. Do you think it's possible that assets with poor ESG credentials, I guess I'm thinking whether is it coal-related or utilities and so on, eventually become so discounted that they offer a substantial return premium? And if so, how might institutions balance return versus the social objectives? Lucas, you want to have a go at that first?
Sure. So look, I think theoretically it is possible. I think we're there? No, but theoretically it's possible. The way I would juggle this is because when you start to get a green premium here, what this effectively does is it actually means that your returns from engagement go up. So to the extent that you can lift a company's ESG performance, you can actually realize a financial return by getting a premium on the multiple from re-rating the company. And so that's how I would tackle that problem if it did appear.
Sharia?
So I agree with Lucas in that it is theoretically possible. We're not seeing it really in a strong way. There may be some elements of some sort of stressed pricing around the imminency of transition risks, especially when it comes to certain pipelines and refineries and other kinds of sort of fossil fuel infrastructure. Perhaps there are seeds of that today, but that sort of extreme deep discount, I don't see that yet. As for how investors should handle that, it's really up to their objectives, and every investor has their own sort of unique set of objectives and ways doing good and doing well differently.
Yeah, I think in closing, if I can try to tie down all the points, and it's hard to do so because there are lots of questions unanswered, and I thought if I could ask Lucas probably the toughest question. I mean, we've covered the framework, the definition, we've covered the use of data, and Sharon had given examples in the data for repricing in terms of new opportunities, whether it's hydrogen and elsewhere. Lucas, as an investor, you see all these things, you look at the portfolio, you understand to the extent that it's feasible and things changing, the impact on climate change exposures. I guess the tough one is, what do you do? Are you at the stage, or at the fund at the stage where you're able to then say, with what's out there, regardless of not being complete in some shape or form, but enough information, data, and so on, to effect certain changes? And have you gone up and would say, look, we'll make certain buy, sell, hold decisions? That's probably the tough one, but if you could give us a sense of how you think about these things.
Yeah, so look, I mean, the reduce strategy, we've already implemented it, and it's been running for 5 years now. And look, we've managed to reduce the carbon intensity of our portfolio by 50% now. Does that solve everything to do with climate change? Absolutely not. But I think it's a good start. On the bottom up approach, look, we're not perfect at getting complete analysis of every single risk every time. I don't want to give the impression that we are, but at the same time, there have been decisions that investments that we haven't made because of their climate change risks, and I think it's still early to say whether that's going to pay off in the long run, but I'm glad that we aren't in those investments now. Yeah, and then I guess the last bit, which is the search, I guess. We have struggled to date to find a lot of attractive opportunities, but we're now just starting to see that actually we're starting to find pockets of good opportunities recently.
I think there's probably certainly scope to talk about hydrogen and so on in a different conversation. Lots of emerging technologies out there, as Sherry alluded in his research. That's really all the time.
Okay, yeah, sure.
Go on, sorry, Luke.
I was just going to say, like, I think what's changed is those have gone from very nascent technologies to still nascent technologies, but a little bit more developed.
Yeah, I think certainly there are options out there, and I was going to say, look, that's really all the time. We have a big thank you to our speakers, Sharia and Lucas, for sharing. Appreciation also goes out to PGIM and New Zealand Super. Now, clearly, as I articulated earlier, this is an area that still needs work. There's still lots of questions, but that doesn't stop us from hopefully making progress with the data revolution, the granularity that Sharia had mentioned, and hopefully this will go some way to encouraging us to just continue to make the difference to our portfolios and to the constituency that we serve. I hope this session has been meaningful for all our attendees. Thank you for your attendance. Stay well, and I hope to see all of you in person very soon. Bye for now.